Hello and welcome to the February Dolfin investment video. I'd like to introduce you to Matthew Barnes, who's with Rubrics Asset Management. Matthew runs the Global Credit Fund, and Bastian Wagner, who's Dolfin's very own in-house credit expert. Gentlemen, thank you very much for joining us. The first question is really a broader question. First of all, what is your brief view on the global macroeconomic environment? And most importantly, how does that then impact on the credit space?
Initially, it really depends a lot upon sentiment. So what we had in the fourth quarter was a very, very bearish sentiment. And I think in fixed income markets, they tend to get their lead from what actually happens in the equities market. So the increased volatility in the equities market gave rise inevitably to increased volatility in the fixed income market. So hence, we saw credit spreads widening. We saw a lot of unease about tariff wars and so forth, what's going to happen there. We still have got the Brexit uncertainty, these types of things. Valuations in the equity markets got smashed in the fourth quarter. It impacted animal spirits in the credit markets. Of course, all of 2018 was a difficult year for credit in general. And but the fourth quarter just precipitated those forces.
And within credit itself, obviously, I know it breaks down into investment grade and high yield. Is the sensitivity to the issues that you mentioned, is that more concentrated in high yield, or is that across the spectrum?
What concerns us from a value-based active credit managers is where valuations are extreme. So the areas that we're particularly concerned about is really in the Eurozone investment grade space, where you've seen the ECB buy corporate bonds, which has had a very distortive impact on the markets, and rates are very, very low. So we think that is the sort of area where, from a valuation perspective, there could be some problems down the line because people really aren't getting compensated for the potential volatility that will emerge.
And Bastian, what are your views on valuations in that space?
What Matthew was saying is absolutely right. The market goes through ups and downs. We saw last year, CCCs were the best performing asset class until December. And then the market collapsed and it was actually the worst performing within credit. However, given where we are at the moment with all the uncertainty about China, about the US you were talking about, so what we have been doing is looking at part of the credit market, in particular the bank loan market, that has the ability to benefit actually when rates go up because the underlying issues are priced over the base rate. But at the same time, bank loans have the advantage of being in the top stack of the capital structure, meaning that if things go wrong and we would see a recession or so, we would get paid first, which means recoveries are historically much higher than in unsecured high-yield bonds. And it really comes back to what sort of businesses you also buy, what sort of bonds do you buy. We're focusing on companies with strong fundamentals, businesses that have strong cash flows that can go through any sort of environment in the future. So we're not just chasing yield. We're really looking for value with the right valuations attached to it.
And obviously, Matthew, you mentioned some of the what I would call the geopolitical risks. The economic data, certainly outside of the US labour market, has actually been pretty weak for the last few months, particularly so in Europe, but also there have been some signs outside that, China and even, in parts of the US economy, there's been some signs of slowing economic activity. How does that impact on the way in which you look at the space? And again, does that have a particular impact within the high yield, or is it right across the credit spectrum?
Well, the high yield market in the US has obviously been around for a long time, and many of most of the issuers are very adept at actually managing cycles, and most of them have taken advantage of the generosity of the rates market for a number of years to term out a lot of debt. So most of these companies are well managed. I think the major things that you concern yourself about in the high yield market are more of those sort of structural change issues. The retail space, the capacity for your business model to be decimated by Amazon. They're the sort of things I think normally are the real big red flags in the high yield market.
And Bastian, obviously the actions of the European Central Bank in terms of quantitative easing and the bond buying programme that Mario Draghi's undertaken over the past few years, that's obviously had a significant impact on European credit. What do you think happens to that process? We were supposed to be in a period of normalisation. The economic data has been weak. What do you foresee as sort of future actions from the ECB? And as a result, what do you think will be the impact on European credit?
As you already said, I mean, the central bank, the European Central Bank in particular, stopped their new purchasing program in December. And now we are actually, and which is actually interesting, it came at a time when actually economic data has been weakening since January. And when you listen to what Mario Draghi said at the last conference, they're actually, I think they're also quite unsure about what it means that the economy is now weakening and what it means for QE in particular. So what we know is if the ECB were to decide to re-engage in quantitative easing again, that would definitely have a spillover effect on spreads. That is the normal transmission channel they use in investment-grade corporates. So we would focus on typically corporate bonds that are in the ECB purchasing program, but also on high yield, because the relative cheapness between high yield and investment grade will play a big role when investors allocating to the European high yield market.
And on that point, Matthew, I mean, how does one go about trying to analyse a company and the bonds that they're issuing? What's the basic process of trying to understand that business and whether it's sustainable and whether it can pay back the capital?
Well, I mean, I think the first starting point when you look at how you construct a portfolio is play to the sectors that you know well. I really do believe that you work from bottom up. Of course, you've got to get the kind of have the right sort of balance in your portfolio. But I really think the best approach is really to only add to normally 5 or 6 extra names per year. And for the most part in a global portfolio, you can do that. May well be that an opportunity comes about in a name that you would have liked to have invested in, but the valuations were never there. Then an event has happened, and then you can participate. Like, for example, General Electric. That was a name that wasn't in our portfolio at all on a valuation basis. But then when we had all the hiccups last year, we thought, how can we invest? Because credit investing really is about a lot of small wins. So these are the sorts of things you look at: business risk, finance risk, and again, structural change or regulatory risk, I think, is the other thing.
And anything to add, Bastian? I think.
Well, I would, especially when you look at the sub-investment grade area, one thing we have seen over the last 5 years with QT is that the borrower protection, the lender's protection has deteriorated quite a lot, and that's quite a big concern for me as particular. Where I'm quite keen on looking at bonds, for example, that got issued like maybe 3-4 years ago and have significantly better documentation than maybe the recent ones. So from the same borrower, and you get very similar valuations. So on top of like the analysis for the business risk, we're looking at the cash flows, for example, enterprise value, but also like what is my right as a lender if things go wrong. I think that's something that will change with the next recession or next downturn. But at the moment, it's something clearly a concern, and where we as a fundamental investor need to be very keen on looking at.
And has the market really forgotten how to deal with companies when things go wrong? I mean, it strikes me that it's been such a long time that many market participants don't even remember the last time that we had what I would call a sort of normally functioning credit market.
Yeah.
I think you see it in a number of areas. You see it in when you have DM motivated investors investing in EM credit. They actually can't handle complexity or uncertainty. They're uncomfortable with that. But when you buy an emerging market name, even if it's investment grade rated, you will get these things inevitably. And
both of you invest on a fundamental basis, and neither of you try and replicate an index. What advantages does that give you? What's actually happened, perhaps more recently in the last couple of weeks, where the new issue market, normally the usual convention is that new issues should be priced at a premium, so you get a concession for participation. But the big names and the big funds are so desperate to get an allocation that actually the pricing has been inside the existing curve. We've really been concentrated in the 1 to 3 year space. Our duration, it was about 2.1, but we started this year with a running yield of almost 5%. So the thing is, you can just pick off bonds that other people have no interest in,
because in many indexes, if a bond is less than 1 year, it actually drops out of the portfolio.
A point which is always raised with me by investors when we're discussing portfolios, and that's the financial services space. And do we as investors want to be lending money to banks?
Yeah, I guess there's two answers to it. First of all, which part of the capital structure do you want to invest in banks? And the second question is on an absolute basis. So how much exposure do you actually want? As you rightly said, there are a lot of structural problems in banks, and a lot of banks, particularly on the continent in Europe. The US banks do look much better.
Matthew, is that similar in your approach?
We've invested right across the capital structure. So we've had senior, tier 2, old style tier 1s, the COCOs that were an interim bond that actually aren't around anymore, and the AT1s, which are sort of, if you like, taken over from the old style tier 1s. And our view is that European banks effectively work for the bondholder. You do have to be careful on what you buy, and there we think the best approach is to go for the larger names, the national champion names. We generally focus more in the UK, Switzerland, France, that sort of thing. We've avoided Italian banks generally, avoided Spanish banks. It's not so much that you can't find good ones, it's just that we don't need to go there.
People talk about duration. I mean, essentially, what is duration, and what's your view on where investors should be positioned right now?
So duration is really the sensitivity of a bond to changes in interest rates. So obviously, when you are in a situation where interest rates go up, the principal of your bond falls. So if you have a view, and we think, which we have, that interest rates might go up in the United States over the next 2 to 3 years, then you want to stay actually more on a shorter duration space. We can actually hunt names, especially like in the B-rated, triple C-rated area, which are have very little sensitivity to actually duration, because the idiosyncratic risk is much more important.
Matthew, I mean, anything to add on that? Particularly, obviously, since you tend to have less exposure to high yield and much more exposure to the investment grade universe. Is your view on duration broadly similar?
Yeah, I mean, with this fund that we manage, I've generally kept duration below 3.5, and now it's at about 2.1. It was 3 about 12 months ago when we brought it back in first quarter 18 to under 2.4. So we just feel as though that's where your margin of safety is better. It means that you've always got some cash to put to work. What you find is that we're the price sensitive guys, and we're trading with people who are time sensitive. And those time sensitive players aren't price sensitive. They just want to trade. And that really gives you the opportunity. So fixed income's a fascinating area like that.
And I mean, I suppose to both of you, I mean, is there ever a struggle to deploy capital? Is illiquidity ever present in the market, despite obviously the fact that you're both, nimble investors?
Well, I think in a month like what we had in January, you really don't want to be chasing and going into the market. I call January FOMO, fear of missing out. And that's effectively what a lot of the people putting money to work in January were doing. Perhaps they were more positive about the environment, but they needed to allocate and they needed to put money to work. I think patience is really quite important. So I think it's really about having a process, sticking to the names that you know, and never feeling like you have to chase a trade. I think that's what you've really got to avoid.
And do you notice similar things, Bastian?
Yeah, definitely. I mean, I fully agree with Matthew here. Stick to your process, stick to the things you know, and then wait for the opportunities. They normally show up. And we have done it quite well, especially not only on an absolute market perspective, so many markets, but also individual names. So there were names which we have been looking at for months and months, but they were simply too expensive. But then something happens. Maybe there was some noise in the market, in an industry or whatever. Think about the oil price, for example, when that fell. So we were able to actually pick up names which we really like from a fundamental perspective, oftentimes 10, 12 points lower from where they were trading a month or so ago.
Yeah, well, I mean, obviously confidence has returned to both equity and credit markets in the last few weeks, despite, as I say, that weakening underlying economic data. Much of that, as you've pointed out, is really down to a much more dovish stance from the central banks in particular, the Fed and the ECB. But I mean, what's probably, it's a bit of a cheesy question, but what's the one thing that's occupying your mind most at the moment? Bastian?
Well, I think if you look at the economic environment, the actual economic data, which is getting worse in China, in Europe, US is heading up quite okay. But I think there are two aspects to it. The first one is default rates can go up if economic activity goes down. But at the same time, we know that central banks stayed ready. So you might have an environment with lower growth, but at the same time also like probably a market which can be quite bullish.
Yeah, so it's somewhat of a perverse outcome.
It is, yeah, it is.
And probably not the outcome that fundamental training would have necessarily taught you.
No, definitely not.
Yeah. Matthew, similar thoughts from you, or?
Well, I think the rules have been rewritten since 2008 in that now central banks provide liquidity. I mean, names like Lehman Brothers went to the wall effectively because they couldn't get funding. If you actually are solvent in terms of having enough capital, you will get the funding. Certainly in the Europe, in the ECB, that's already formalised, but the UK can easily turn on the tap and has done in the past with central bank programs. And in the US, very easy for banks to get the funding they need from the Fed.
Matthew, thank you very much for joining us. Bastian, thanks for your time. And thank you obviously for watching. Don't forget to go to dolfin.com to download your copy of the February investment review, and we'll see you next month.